talking about career risk and that sort of thing. And you're touching on a topic that we've discussed internally and in other episodes quite a bit, which is this reflexive nature of passive flows and what's been happening with the drive towards index funds and all that. But before we go down that reflexive rabbit hole, I wonder if we might talk a little bit about some of the adjustments that you see that are relevant in some of the valuation analysis that you do. Adam, you probably remember this. I'm reminded of a paper that the pseudonymous Jesse Livermore did about the corporate earnings mirage or something along those lines, and how they were overstated to a very large extent. And it had to do in a meaningful way, I think, with the 1970s and 80s and the high inflation of those times. And there were inflation adjustments that needed to be made in order to accurately reflect book value for a huge chunk of the companies that existed back then. I wonder if you might speak to some of the adjustments that you think are relevant.
Sure, would love to do that. Let me run you through 4 slides, because I think we can start with accounting data and end up with economic margin data and see, you guys tell me what you guys think of the adjustments, and we can just kind of critique them and have fun in real time. Okay, let's start here. This is the Ftse World Index. It looks at, this is a 1-year slice in time looking at earnings per share growth against PE. And it sort of frames the whole discussion of what corporate performance measurement is. In our view, and in our humble beginnings in Chicago, what we wanted to do was create an approach that said, hey, if we go to a company and we talk to management, we want to give them a metric that says, if you're doing well, your stock price is going to go north. So corporate performance measurement, kind of the first level of the first ante, if you will, in the game, is that you need to have a metric that says if you're doing better or worse, the market is somewhat recognizing that in terms of valuing your assets. So when you look at earnings per share growth or earnings growth, net income growth against PEs, in theory, more net income is a good, so you should be trading at a higher PE, right? If earnings truly had a lot of information content by itself, the faster I'm growing my earnings, the more I should be willing to pay per dollar of earnings because it's more valuable. There's too much noise there. There's not much relation at all between them. And just kind of a couple factors going to the from a bigger picture perspective of the adjustment. Earnings does a horrible job with cost of capital. It assumes the cost of equity is free. It doesn't handle inflation well, doesn't deal with cash flow. You know, there's a number of accounting issues that distort earnings. When Exxon builds a new rig, it gets to put it on the book and match it to the earnings it generates over time. When Alphabet invests in a new algorithm, it has to immediately expense it because it's R&D, right? So just by point of reference, in 95, there's different studies that show that tended to be the inflection year when intellectual capital started to surpass physical capital expenditure in corporate America. So this is something we were aware of that had kind of been percolating for a while, so we wanted to explicitly address this. So let's
just to press pause on that, because I feel like you've circled this a few times, so I want to make sure we explore it thoroughly. So am I right that primarily the adjustment you make due to the example that you described, where Alphabet's algorithm gets expensed in that year, whereas a rig from ExxonMobil gets capitalized and accrues over many years. Are you primarily capitalizing R&D? Like, is that a fair kind of?
So that is, yeah, absolutely. That's a key adjustment we've made forever since '95. Yeah. So
how to what extent does just capitalizing R&D, like if you capitalized R&D and then use PE or price to book as your
your metric,
as a simple sort, do you have any sense of how what kind of impact that would give you, or like to what extent that would close the gap between those sort of simple cheapness metrics and your value concept?
Great point. So let's look at this. This is Amazon I believe this is Amazon in 2017. Okay. Net income for Amazon was $3 billion. R&D that year was $12 billion. big difference, right? You're talking about a factor of 4 at that point. Other adjustments that we go through, we're adding back depreciation. That was an $11.5 billion. Operating leases, which essentially is debt that they were able to keep off the books through a number of accounting conventions, $2 billion. A couple other adjustments, a couple $100 million. All of a sudden, you go from $3 billion of net income to almost $30 billion of what we call operations-based cash flow. For a company like Amazon, you're off by a factor of 10 when you're just focusing on the earnings number. Going back to answer your question, Adam, what's the effect? It depends on the company. It really does. You can look at things in aggregate, and I think what's interesting is there was a study put out by Campbell Harvey and Rob Arnault, where they went back and they capitalized R&D for firms and just added it straight back to book value, and then reran all the price to book metrics. The bottom line is it improved them, but they price to book significantly still underperformed. And we actually
that's not a magic bullet.
Certainly, it doesn't fix it. It probably, I would say, and I agree with the adjustment. My comment on that, though, is adding back R&D or intangible type expenditures for a firm like IBM has a very different economic impact than if you're capitalizing and letting the value effects flow through for a firm like Alphabet. Right? The return on investment to R&D has been very different over the last 10 years for Alphabet versus IBM. And treating it that you're just adding everything back to book value and everybody gets the same multiple of those intangible expenditures, I think is not a very robust way of doing it. I think to handle it right.
Who's to say that the return on R&D investment between IBM and Alphabet is not going to mean revert over time?
It may, but that's something that today, if I were to bet on the incremental return to an R&D investment for Alphabet versus IBM, and I look at Alphabet's history of what we call economic margin, and we'll show you how we get there, I would say I'm much more willing to pay for Alphabet's incremental return on that R&D than I am for IBM. I wouldn't treat them the same. Doesn't mean they won't mean revert, but there are other ways of handling that as well, in the sense of, and we can get at that, because the way we think about valuation is very different than saying, okay, we're going to take $1 of cash flow and capitalize it at 10%, so it's worth $10, right? That notion of capitalizing and using kind of a Gordon growth perpetuity approach gets to your exact point, and that is competition never affects returns. Mm-hmm. I think a much more insightful way is to say, look, certainly today, my best guess is Alphabet is doing much better than IBM, but I believe at some point in the future, the economic return to Alphabet is probably going to start approaching average. And in an economic sense, average is my ROI is equal to my cost of capital. Mm-hmm. And so the question then becomes, this is not a perpetuity. It's a question of saying, okay, can I have a reasonable approach to say, how long am I willing to pay for Alphabet to have these excess rates of return, what we call an economic profit horizon?
Right. So economic profit is ROIC minus COC?
Correct.
Okay. So,
and for most firms, that's zero, by the way. For most firms, it's zero.